Sailing through uncertainty. We have Dan Nathan, a CNBC fast money contributor and principal at RiskReversal. We have Joe Marchese, executive chairman at Human Ventures. Allison Goldberg, managing partner at Comcast Ventures. And Robert Niehaus, chairman, co-managing partner, and GCP Capital. And finally, we have our very own Chief Financial Officer at Zeta, Chris Greiner.
Okay, thank you guys for being here. That was actually a very fascinating conversation. Well done by David to get that out. This will be a bit easier here. We have some serious practitioners in a lot of the stuff that you're here to kind of talk about and think about or whatever. So I think the way, just that kind of art and science, I think, Chris, you came up with that. It was the kind of push and pull between the art being the CMO and the science being the CFO. So we'll drill down on some of that stuff. But I want to start with Allison here. Joe and Allison and I speak a bunch about this sort of stuff just kind of casually as it relates to the day-to-day of the businesses. You guys as venture capitalists, it's just an interesting time right now. We've talked about this ad nauseum, at least I know that I do, is that the period that we've been in over the last 10 years feels a bit unnatural as it relates to capitalism, or maybe the way that all of us have kind of thought about using productive capital. And, there's just been billions and billions of dollars thrown at marketing in an effort to gain customers. So talk to me right now. We're in this period where there is a whole heck of a lot of uncertainty. We had a panel earlier today where, yes, the Black Swan event that was the pandemic, that was a thing, but now we're in a period where it's equally as uncertain when you think about 40-year high inflation and interest rates at levels that we have not seen, or a lot of entrepreneurs have not seen. So how are you thinking about advising the companies that you've invested in, and just based on your experience over the last 20 plus years in the business of marketing?
Sure, thank you.
Yeah.
So it's an interesting time. I've been in venture about 22 years, something like that, a long time. So I've seen a lot of the different cycles. I'd say at the past couple years, I guess mid-pandemic on through earlier this year, there was just so much money thrown at companies, at private companies, and very high valuations, tons of capital, just record highs in terms of how much money these private companies were raising. Things have slowed down this year significantly, and a lot of companies are finding it a lot harder to raise, especially the early stage privates. Either their valuations got way too high, so then it's harder to raise again at such a high inflated price, or the companies haven't sort of proved out enough to raise that next round of funding. So we're seeing a lot of companies just think through cost structure and try to be more capital efficient. So they're thinking through, where can I cut? How can I make the money that I have now last longer? So we're just seeing a lot of the companies that I'm advising or on the boards of just think through spend and how to be more efficient about their spend.
So Joe, as a former operator, but now someone who also invests and advises, but an operator in the marketing space specifically too, how are you thinking about it? Do you come at it from a different angle because you didn't come at it originally as an investor, but you are now? And I know that you're somebody that people look to for this sort of advice, and you've seen downturns.
Yeah, so I'd built an advertising technology company through a downturn, and then went into 21st Century Fox and ran the advertising business there. And I would say in times like this, what is very interesting for all these startups and also big companies is advertising gets cheaper, because the companies Allison was describing, companies that have no cash flow and no product market fit, can still spend a ton of money on advertising. And that kind of drowns out companies that have product market fit, but they don't have a lot of funds to put into advertising. So even CPG companies launching new brands, finding a customer gets not a lot easier, I shouldn't put it that way. It is easier to find your customer when you're not bidding against people with just huge coffers. So I think being opportunistic and very smart about marketing in times like this is a big opportunity.
Right, and we're going to get to some of the technology that's changed over the last, let's call it, since the last crisis. That's probably really helping, I guess, brands focus on ROI. Bob, you come from this as slightly, banker guy, right? And so when you think about some of the companies that I think you're advising or invested in or just in your ecosystem, a bit more mature, right, than some of the ones that maybe Joe and Allison are focused on. Talk to us a little bit about that and how you're thinking about it.
So we do later stage growth, and I always tell the companies that it's a little bit like going on a diet as a person. You have to give up some things, like sweets, alcohol, whatever you need to do. And they're generally things that aren't essential for the near-term health of your own body. And so in a recession, I tell them to focus on the low-hanging fruit and really focus on things that will help directly sell your product or your service, whatever it is the company's offering. Brand building is important in the long term, but you need to have funds to survive to the long term. And so to me, it's very much go out, low-hanging fruit, and also use channels and partners that have very identifiable ROIs and identifiable customer attributes.
So Chris, as the CFO of Zeta here, how have you seen, again, all of these pressures that we kind of just talked about? Uncertainty is uncertainty. No one knows the future here a little bit. But when you guys think about, kind of your experience in 2020 versus right now, I'm sure you learned a whole heck of a lot in 2020. But how are how is the Zeta data cloud? How are some of the services and the products that you guys have? How have they just kind of come up to speed really quickly in the last couple of years, and how are you thinking about this current period of uncertainty?
It's a great question, and for Zeta, we invested through, and I think you'll hear a theme, you have to prioritize, but we invested through the pandemic, and that is why you see the product leadership that we have today. It's interesting, we very much oriented around a formula during the pandemic, and it was a formula around if we wanted to drive sustainable growth, sustainable and growing margin profile like we've been doing, like we've done now in our public life, you followed the formula of focus on quality first. Kind of you would think originally you need to get productive, you need to cut costs, and that might be the disposition of most CFOs. My best lessons came when I was a chief product officer and COO of a healthcare data analytics company in the public markets. And what I found out was that when you focus on quality and then you focus on speed, productivity takes care of itself. So at Zeta, we invested heavy in engineering, quality, build a great product. We invested heavy in sales and go to market, get to customers faster. Everything else in the middle was kind of up for grabs for productivity.
Yeah.
And that's the formula we followed, and I think it's gotten and built this bow wave of momentum that we have right now.
So Joe, there are very few people that I know who think more about brand, and I mean that sincerely, than companies that you've helped incubate, that you've invested in. Bob's point about going on a diet and something has to kind of be excluded a little bit. When you think about ROI in difficult times like this, does brand suffer? Does brand building suffer?
I don't know. I mean, it's what I would say, what I would challenge that is being smarter about brand building. And also that there's science to brand building too. Like there is use of data the use of data is to reach your customer, right? Then that's one use. And then there's use of data to measure how effective was it, right? The question of measuring how effective was a marketing message is just a question of time horizon. Was it effective as in I bought it tomorrow, or is it effective as in I bought it next month? And then which thing was it effective doing? Was it effective in getting me to buy it, or was it effective me to be willing to pay a higher price for it? Or was it effective in me telling my spouse that, hey, yeah, I really do want this new, I mean, the time horizon on purchases and the value of brand and what you're using data to do, I think that there's a false dichotomy between upper funnel and lower funnel. And I think the data being used at upper funnel to do brand building is super important and to inform your marketing decisions. And I think where it came from is Facebook and Google controlling the market. Like we say, there's brand building and then there's direct response. And direct response, Facebook and Google are always going to win in their own, because like you're coming to fight them on their playing field. And so I kind of have this tendency to believe that Facebook, Google, Amazon now have convinced the world if you can't measure it, don't buy it, which makes me think everything that's hard to measure is undervalued. So if you can find data sets outside of Facebook and Google, and this is one of those, and you can use that to inform marketing decisions, and you can do things that might be hard to measure. I happen to love billboards, but when a startup comes to me and says, how do I know if the billboard's working? I'm like, your time horizon, just tell me what your time horizon is and we can start working backwards from it. Also, did you know whether it was there or not? Isn't as much of a question with billboards as it is with digital. And so these things can kind of feed each other. So I guess that was the longest-winded answer to it depends.
I mean, I'm literally on the edge of my seat for that long answer. Allison, how do you think about it? And again, do you want to make some? Is it industry by industry? I mean, are there different thoughts that you have in that regard?
Yeah, so we work with a whole range of companies, and we've got companies that do consumer marketing, direct-to-consumer marketing, things like that. And then we've got companies that are more B2B SaaS companies that I'm on the board of and advise, and their marketing looks very different. I would say there's an increased focus from like a board perspective and investor perspective around, did it work, right? Like, let's look at all the numbers, especially on the B2B side on sales. The magic numbers are all around sort of customer acquisition cost against long-term value of the customer, right? And you're trying to make that as high of a ratio as possible on the LTV up top. And there's a pretty big focus on, let's look at every dollar we've spent, because the dollars are more precious now, and understand how many trials it drove, how many customers it ultimately brought in, and then what's the value of that customer over time. So I'd say on the B2B side, I'm not seeing the marketing budgets go down, but we're seeing a lot of more scrutiny on just, did it work, and how did it work, and how do we measure that and make sure we're doing it right?
I think the thing that's changing the fastest right now is the medium shift, like between like the TV world of old per se, which is now left to news and sports, to CTV and streaming television, and then the streaming television channels becoming infinite. So how do you get smart about what you buy on CTV? Like, how do you get smart about buying at a household level, like data? Because this goes back to, we've gotten used to, we target on a cell phone because there's one person usually looking at a cell phone. But if a TV is on a wall, like television had this stat, saying called viewer per viewing household. How many people were watching in a household? That makes you think you can't really target one-to-one, right? You're targeting to a household, and so getting smart about what you're going to buy on CTV. There's whole new channels. There's all these fast channels. I think that's like one of the things people should be spending a lot of time thinking about.
So Bob, you've thought about these over some cycles over the last, let's call it 30 years, and there's been periods in which you've seen, companies that you've been advising, invested in, however you want to say it, they've had these sorts of pressures, but the secular shifts, and I think what Joe's talking about right now, the way in which, people are finding new customers, building brand, evaluating the value of the spend, how has that changed right now in your opinion? Like, and is the accelerations we're seeing, are they going to continue at the speed? Again, I think we've spent a lot of time today on this floor talking about how much has been learned over the last couple of years during this crisis. Are we going to continue to see a sort of acceleration? And what's different this time, I guess, versus past crises?
Well, I agree 100% on the acceleration of the channel. It's such a different world than it was 10 years ago. You can't believe, and even 5 years ago. And CTV is a great example. To me, the bigger change coming is, for the last 15 years, capital has been very inexpensive. We've had the longest period of negative real interest rates in history. We've had unprecedented amounts of government stimulus spending, part of which brought on by the pandemic, but part of it just a general broader government safety net. And that period has ended, and it's ending relatively quickly. And the fact that the Bank of England had to intervene yesterday to save a run on the pound because of some pension funds that had too many floating rate liabilities and had to post collateral tells me that capital's going to become more expensive. I remember after the 2008 crash, capital became very dear, and marketing budgets and the like have to Allison's point, really stand up to scrutiny. You have to demonstrate what the ROI and what the period of time is. And I always tell people that when I want to build this business or this new product, and I'm like, well, the pioneers wanted to go to California, but you have enough provisions to get across the desert and the mountains. So you have to make sure there's enough capital and you have deep-pocketed enough investors that you can get across that desert.
I have a question. I've had this thought, and I don't know where it's going to end up, but like, corporate profits are an all-time high, and corporate treasuries are full of cash. There's inflation, as we all know in the market. We're all hearing about it. There's only a couple of ways large corporations can spend money. They can give it back. They could do R&D. They can do M&A. The largest of companies really are kind of stuck, can't do a lot of M&A. Or they can get new customers. New customers comes from sales and marketing, right? So as corporate profits remain high and they don't want to keep cash on the books, I think that there's like, you see it right now in like in the Fortune 500, like marketing budgets are relatively healthy. I don't know how that kind of trickles down to the tail and the mid-sized companies, but kind of in this market where a lot of the free money is gone and the corporate profits are there, I think you're going to see a kind of a barbell of who's still spending on marketing.
Possibly. I mean, what's going on, I think when you're talking about corporate profits, you're talking about profit margins, right? So we're at peak profit margins. And so when you think about, okay, we keep hearing about, inflationary inputs that have come down dramatically. One of the reasons why the Fed has raised interest rates so dramatically, so quickly, is to do just exactly that. When you think about like how monetary policy works, there's a huge lag, right? And I know Bob is very familiar with all of this, and we might just now starting to see some of the stickier parts of inflation, how they attach themselves to companies and their cost structures and stuff. So to me, I think it's kind of too early to kind of get out there and say the mission accomplished thing on a big aircraft carrier. But the point is about these budgets is that, I mean, when you think about how to pass through increased costs, you do that at the expense of margin. We're starting to see headcount reduction. You're starting to see probably on the margin, you know what I mean, like some real pressures on marketing spend. But I don't think we're going to know for a while. And the other point is that when you think about this monetary policy of free money, which Bob just alluded to, is a 20-year thing now, and the speed in which that has reversed, I don't think anybody can really forecast what that means. I think we'll be talking about this for a while. Chris, as a CFO, these are all topics on your mind here. How are you thinking about the speed in which macro has changed and how different it has been for the last 2 decades?
It's evolved our conversations even from the time of our IPO to now recent conversations with investors, where, to your point, while corporate profit margins at the adjusted EBITDA line might be the highest, they're probably not the highest when it converts down to cash flow, which is really important and is certainly taken on with investors and analysts more importance in our dialogue. And when you think about kind of Zeta's journey, while we are growing our adjusted EBITDA margins, what we've also been growing at the same time is the conversion of that adjusted EBITDA to free cash flow, because it is that free cash flow at the end of the day that builds our war chest, and our war chest right now is devoted towards building sales and marketing, even in tough times. We are growing our sales and marketing spending at a rate faster than revenue growth, but where we're driving savings from is on the G&A line, and that's consistent with our longer-term model and something that we're devoted to and committed to as a company.
And I think that's going to keep happening at large companies, and I think you don't want to, well, you look for some upsides in down markets. If you're a venture capitalist, you're always trying to be an optimist about what comes next. Small companies have no fixed cost structures. In an inflationary environment, fixed cost structures are the hardest thing to bring down. The other thing I keep telling companies is build value. Like, no matter what happens, they're going to pay for your company and whatever the value is in the future dollars. So, if you build a tequila company that's worth $1 billion today and inflation's riding, and someday in the future it's worth $10 billion, it's worth $10 billion in those days' dollars. So I do think that there is a lot to be like an upside or a bright side for smaller companies in this market if they can get the capital in the door and deploy it right.
So Allison, some of these smaller companies that Joe's just talking about, again, those fixed costs, I mean, we're starting to see headcount reduction. I mean, how aggressively in the companies that you're advising, without using specific names here, are you kind of helping them move here? And what, like, is it going to be, little cuts here, 5%, or are you advising, big cuts, 20%, that sort of thing?
I mean, obviously depends on the specific company, but we're advising, like, try to get 12 to 18 months. So if you're raising money now, where you used to think you could raise again in 6 to 12 months, right? Capital was basically free. Valuations were really high. Now it's, let's get 12, 18, maybe 24 months out of the capital you have at hand. I don't like little cuts a lot, you have to make the decision and do it once, because it's really bad on company morale and company culture if you're constantly cutting. It's not a great place to be. So it obviously depends on the company. If you need to do 5, you need to do 20. A bunch of my companies have been super proactive. So the CFOs, or they don't have a CFO, head of finance, most of the companies, because of COVID, they sort of went through that exercise already a couple years ago, so they're sort of used to it and have come up with scenario analysis. So for the next 12 to 24 months, here's 3 cases. Here's what we're going to need to do. If the revenue is not ramping the way we want, we're not getting to sort of the optimistic case, here's what we're going to do from a cost standpoint to bring it down to make the cash last. And I'm seeing that pretty much across the board. But I think, yeah, we're not seeing, it tends not to be like marketing gets cut specifically. Sometimes it's really, it's more on the G&A line, as you were saying, on the headcount side of things, and then real estate. Like, people aren't renewing leases. Most of my companies have been fine virtual and don't necessarily want to come back. So to the extent they don't, I have a couple companies with 10-year leases that they're trying to get out of. If anyone needs some space, I've got some space. But that's a big area that I've seen come out of some budgets. Yeah.
I agree with Allison that the small intermittent cuts are less effective, and I think it reinforces whether you're a small company that is on a hypergrowth path, whether you're a mid-sized company that's on a high growth path, or a big company that's managing for cash. The value of having a long-term plan, whether you externally release it like we did, or you have it internally in-house, the fact that you can be on a rolling plan and not have to go through these kind of herky-jerky motions with your teams, I think, A, builds confidence in the employee ranks. It certainly builds confidence because you have this joint accountability with your external parties that you've said, this is where I'm going. When the environment changes, because the buying environment will always change, you don't have to kind of zigzag your way there. You have a plan and you just kind of stick to it. So I think that works, and I agree with you. If you're going to do something, do it big maybe once, but keep to the plan, right? Our CTO says, plan the race, race the plan.
Yeah.
Right? It really works.
It seems like there's a lot of coded messaging right now. I was at the code conference a couple weeks ago, and Sundar Pichai, the CEO of Alphabet, I mean, he just it was like a throwaway comment. He's like, yeah, we're looking to become more productive, like 20% more productive. You know what I mean? And so then there was just like reams of stuff written about what he meant and that sort of thing. And we know that some of the
He means moving to Zoom instead of Google Teams.
Yeah, there you go. Yes, please do that, everybody. No, but
Google Meet.
But
combining
it feels like, Bob, are we just kind of scratching the surface with some of these, some of the biggest companies out there? Again, we keep seeing stories and stuff written about just how we're correcting for just the over exuberance in this prior period, and then also there's just the really odd dynamics of the pandemic and the work from home, and so some of these things are just going to stick. I mean, hybrid working is going to make I think a lot of workforces a lot more productive. It's going to be cheaper to do the same things. Thoughts here, because this is a really big difference here, and where are we? Are just scratching the surface on this?
I think so. I mean, a couple of us have already said that the pandemic just accelerated what would have been a 5-year evolution of technology, or 5 to 7 years, got compressed into about 18 months.
Yeah.
Everyone learned how to work virtually. Everyone learned how to do more distributed data. People put a lot more stuff in the cloud so their employees could work remotely and draw it down and work from home. And those changes aren't going away. And so that, to Allison's point, the bigger companies have a bigger issue because they've got all this real estate. My office is Midtown Manhattan. Half the offices are empty and are going to probably stay empty. And so they're going to have to figure out what to do. There's you'd be happy if you don't own commercial real estate in New York City right now. But so yes, we're just, bigger companies have to restructure. I also think that the acceleration of the technology has meant the declining channels are declining faster, and the growth channels are growing faster. So, making sure you know where the puck is going, not where it's been, becomes even more and more important. You have to make sure your CEOs are really paranoid about change and where things are going. And, the cost of capital is going up. And so you have to be a little more focused on that. And the value of the long-term customer, Allison talked about that before, is probably the single thing that some of our companies don't focus enough on. How much are those customers worth in the long run? How long do you keep them? And who are the ones that are worth the most? And then, Joe, to your point, I would do brand building for them, because that, those long-term customers with high value added, that's what makes companies really valuable.
Yeah, I'll be curious to see how much is kind of recency bias on the hybrid workforce, the work remote, because most of the people before the pandemic, they had worked together before. They had been mentored and taught. They had social connections and cultural connections with people at work. Then they went remote. And then they love remote once that's the case. we have a whole generation kind of coming up right now who like haven't met the people that they work with. I think I've got some startups like that are starting from day one, employee one, saying everyone's in the office, right? That one you know well out in LA. And they just said, this will be our superpower because like we're going to be connected, we're going to have culture, we're going to do these things. And like, I think there'll be some of that. There'll be some that do a very good job of pure remote. Like Matt Mullenweg they always use WordPress as an example, but he built that into the DNA of WordPress that they were a fully distributed team from day one. So I don't think that we're going to refill commercial real estate in New York like that. Like Midtown's going to have a hard time figuring out how. But New York bounces back and always finds a way, so I've got high confidence there. I'm not as confident in some other cities. Maybe Miami if the mayor's still here. So I'm curious about that. The other thing though is that I think a lot about, and I talk to the companies when there's inflation, and then there's this disaster, and then this is changing in the macro environment, and then oh no, like. With all of the changes, like Sun Tzu had a thing where it said, like, I'll butcher the paraphrasing here, but it's like when everyone else is losing their minds, the person who does average wins. So I just kind of wake up every morning and be like, do average today, Joe. And so far it's worked.
Yeah, well, so David said this morning, I think it was with Isaiah Thomas, just, kind of never waste a good crisis. Anything that is on the tip of your tongue, Allison, as far as, like, this doesn't feel like a crisis yet. And when people ask me, I think that there's a lot of dynamics as it relates to the economy, as it relates to just markets and stuff that I feel like are, little bits and pieces of the post-dot-com era, of the financial crisis. And I think, to Bob's point is like, some of you guys might not be focused on commercial real estate, but that could become a thing. That could be a tipping point in the credit markets. It could be really find its way seeping through to the equity markets and into private valuation. I mean, the list goes on. And so I'm just curious how you think about that phrase, because again, it's an important one here, but if you make the wrong decisions too early in the beginning of a crisis, you could be out of business by the end of it.
I mean, for private companies in venture, it's always interesting. It's always a lag. So they're not always thinking about, the general macro environment, what's going on in the stock market necessarily, or any of those things. I think right now it just feels heavier because the venture market seems to have slowed down a bit, but there's still plenty of money in the market that will come back. So I think it's more important for these small, especially the earlier stage companies, is just really work on product market fit, understanding who their customers are, super serving those customers to the extent they have them, and just making sure they have the capital to get through the period. So just not wasting the money. So making sure you have the 12 to 24 months or whatever it needs to get to that next proof point so that you can then prove out, we have created this great product that really works. We have these great customers who love us. Yeah. They're valuable. So.
All right, Chris, final word to you here, because again, you've been CFO of a private company, tech company, and now you're the CFO of a public tech company. Any thoughts on the experience of just those two, and how that might be relatable to some of the people here in the audience, and some of your sensibilities about that?
It is certainly easier to operate and be a CFO in a private than it is public. You just can do a lot more behind the scenes, right? But being public drives a lot of accountability inside an organization, especially use of capital. So kind of back where you started, if the concept is, the CMO is the artist and the CFO is the scientist, where they have to meet in the middle is on ROI. And ROI can be creatively visualized, and it can be quantitatively calculated, right? And you're never going to be able to make pure numbers-based decisions on everything. But how close can you get in a private company world or in a public company world to making those decisions around ROI? And then, Joe, I love how you put it, just tell me your time duration, because then the ROI becomes very different. If it's a year out in this market, tougher to get a business case closed. If it's 90 days, yeah, we can make that work. So I think if you're aligned on the horizon when you're making these decisions, and you also align on ROI as being your decisioning point, I think you can make very effective long-term and near-term decisions.
Okay, well, thank you guys very much. We are out of time, but Bob, Chris, Allison, and Joe, thanks for being here, guys.
Thank you, Dan.
Thank you, Dan.